Cool. All right. So, hi, everybody. Just want to introduce Ang. So, I've known him for almost, I don't know, 8, 9 months now or so. I was introduced through a friend of a friend, and he's a titan in the Kansas City market. And he's going to give us a presentation on real estate and tax. Go ahead and take it away, Ang.
Thanks, John. So this presentation I've done at Apple, where I used to work, and at Facebook, is really geared towards prospective real estate investors now, people thinking about it, as well as people like us who have or used to have high W-2 income. So hopefully you guys will find this useful. It's going to be a lot of information. I'm going to talk quite fast, given we have an hour, and I want to make time for Q&A. But also feel free to interrupt or ask questions along the way. And I will be sending this deck, or I will send this deck to John so he can share with you guys. All right, so pretty long agenda, introductions, my background, talk a little bit about residential versus commercial before we get into the tax part, how to pay less taxes, order of operations, deferrals, depreciation, cost seg, bonus depreciation, 1031 exchange, opportunity zones, income shifting, and real estate professional, and then Q&A. So my experience, first of all, I want to preface this, I'm not a CPA or a tax professional. So don't take this as like literal advice because I don't want to get sued or anything. I am someone who paid a lot of taxes, who has been a real estate investor since 2009, and has talked to a ton of CPAs and read the IRS tax code end to end. Because I'm very self-serving, I want to pay as little taxes as possible, or optimize or minimize my tax burden. My background is did Wharton grad degree in economics, got into finance and analytics, Peace Corps volunteer for a little bit, and did product and then marketing and then analytics and business management and product vision at Apple Music, and most recently led data science at Siri. And now I am CEO, co-founder of Tozy Capital the last few months. So a little bit of my real estate background. I first bought my first rented property when I was 23. I was out of state. I was in DC, but in LA. So I've quite a lot of experience investing in out of state properties. I bought triplex and quadplex, and mostly in the LA region where I grew up. And I've invested also as a passive investor in multiple other people's deals. And now more recently I bought commercial real estate, and I define commercial real estate as anything large scale, including multifamily, in Georgia, Kansas, and Missouri. And I've done some syndications for self-storage and opportunity zones. So my wealth strategy, I think most people's wealth strategy, sort of life journey wealth strategy, is you sort of start saving money first, right? You have to start saving money, start investing in it, but you can't do that to a certain extent. And then I think the next logical route is to start earning more money. I think obviously you should be doing both at the same time. And here's where saving money helped me invest that money into real estate and help me get passive income to then snowball. But once you start making a ton of money, like hopefully everyone is here, you realize that you're paying a lot of taxes. And so your number one expense in life is taxes. So to understand that, and personal economics and personal finance of that nature, is very important. It's something that I don't think I've gotten taught at Wharton or other schools. And I think it's something that's overlooked quite often. So this is just my personal experience with it. I do want to go into a little bit of residential versus commercial because John mentioned that I have a lot of commercial experience. I just wanted to highlight a little bit of where I see the differences. So residential, I think a lot of people start real estate investing in residential is very accessible. It leverages your number one asset, which is your income at this point, for the most part. And that means you do residential loans and they underwrite you as the income provider. They don't really care what the property does in terms of net operating income or cap rate or or cash flow, but it doesn't scale. And that's where I started. I bought 7 of these. I still own 5 of them. Now where I'm going and where I probably would have started if I knew better, we're going straight in commercial. And this includes residential multifamily. I'd say it scales better because it's lower standard deviation of outcomes when you have a single family house that has one tenant that goes bad, especially in California, it's hard to evict. Impossible now, of course. And versus something where you have 100 units, you got maybe 2 or 3 people who has issues, but overall, it's still above average property. The standard deviation of outcomes become less compressed, and you get a lot of diversification there. Financing is a lot easier as well. Commercial lending is much more dependent on the building being viable and cash flow positive. It doesn't really care about you as the income producer. And so the limits on commercial financing is boundless versus residential financing. And then also more control in the valuation. So it's operate like a business. You make, if you have 2 houses that basically make half the money to one another, but they have the same square foot. Residential is all about sales comparable. That's how you value property. Commercial is all about NOI, net operating income. So if you can make more income from a property or make less income, you have more control on what that valuation looks like. And this is, if anyone's been through a residential loan, I've done this a few times. I bought a house this year, bought a house 2 years ago. Just stop buying houses. It's really just start renting. There's a lot of stuff. They ask for a lot of stuff. And if you're like me or used to be like me and had RSUs and it was complicated, it's hard to explain what that means. And you make a lot of money, but they don't know, they look at your W-2. It's really difficult to figure out, and you got to handhold them through a lot. Versus commercial. This is my experience with commercial loans. It's very easy. They mostly just underwrite the business, the asset. And by the way, commercial loans and residential loans as well, but any income producing loans is all tax deductible from a interest perspective. So there's a lot of difference between primary residence and rental producing income producing properties and their tax treatment. Hopefully I'll go through some of that in this deck. So into the meat of the presentation, how to pay less taxes. And I really like to say it's more about how to keep more of your earnings. You are, earn a ton of money, hopefully, and you want to keep more of it. So when it's about taxes, it's about the facts. You have to rearrange the facts. So that's the theme I'm going to go through today. And I think most people are familiar with this order of operations, and I like to abstract things like this. You get paid, you pay taxes, and then you spend money. Employees get paid, they pay taxes and salary, they spend money with after-tax money. That's a very typical, that's probably what everyone does here. Businesses, they earn money, they earn revenue, they spend on costs, so they spend money, and then they pay taxes. They pay taxes on the profits. So a little bit better from a order of operations perspective, because now you're shifting the costs, the expenditures to a pre-tax perspective. There's some things you can do there with personnel as well. And as employees, we're all about trying to shift things and rearrange the facts here. We were trying to create, have tax advantage strategies like 401ks, HSAs, and other pre-tax expenditures. And so this is all what most of our employers offer us. It's all about how can we pay less taxes by shifting stuff that we would probably spend anyways to a pre-tax basis. So the order of operations for employees: get paid, pay taxes, spend money. Businesses, slightly better: get paid, spend money, pay taxes. An investor, which is a hope where everybody is trying to strive for in terms of their second careers or fifth careers like me. We should all try to be cultivating our capital and making them earn money for us, making it earn money for us. And as an investor, you spend money, you invest, you get paid, and then you pay taxes. That's sort of the best order of operations. So one way to rearrange the facts is deferrals. And deferrals by itself is a really powerful tool, and one of the factors people use a lot when they do real estate investing. It's one of the major things they do when they try to figure out how to pay less taxes in general. A 401k essentially is a deferral. You're deferring the taxes you owe by investing the pre-tax income and then paying on the exit, maybe in 30, 40 years. Although I think retirement plans are life deferral plans. I think you can get the same tax treatments as a 401k with real estate. And I'll show you a little bit of that. So deferring taxes for the future is a lot of real estate investing strategy. And one way to defer is depreciation. So for some of you guys, hopefully you guys understand what depreciation is. You guys take advantage of it on your rental incomes right now, rental producing properties right now. But to simplify things, it's essentially it's a tax deferral on a portion of the basis of your property, the portion of non-land value. So if you're buying in California, I think that's probably going to be a smaller portion. But if you're buying in places like where I'm buying in Kansas City, where the land value can be argued to be 5% of the purchase price, not 50% like in some parts of California, you can take a lot of the property and depreciate it. And depreciating is all about a deferral of taxes. It's the way I think about it. And for residential, including multifamily, is 27 and a half years straight line. Commercial is 39 years straight line. So you take the depreciation, the purchase price minus land value divided by that. So here in this example, I'm talking about buying $1 million rental property, putting 25% down, $250K. That's inclusive of all the costs and whatnot, and getting a 7% cap rate and 10% cash and cash. I think I did the math right, but don't check me on it. It's just abstract, illustrative. It's also probably not in California. You probably can't find this type of property in California anymore. Although there's some parts, Richmond, maybe some Inland Empire, Central Valley, but probably not now. So in this case, you're making 10% cash flow on your 250K. So I always think of these investments as a financial instrument, an asset. So things I care about usually is cash and cash, cap rate, cash yield, gross yield, IRR, etc. So cash and cash means I put 250K, I get an annual return on 25K. This is net of everything, right? Cash and cash is net of debt, net of expenses, vacancies, repairs, and maintenance. So you get 25K in your pocket every year, but you also get a 25K depreciation. So your taxable income on your 25K is zero. So you pay zero taxes on it, even though you actually made $25,000. So that's the power of depreciation. So that's probably the big topic nowadays with Trump and whatnot, but that's how a lot of real estate investors pay very little taxes. They use depreciation to defer taxes and to offset their income. So what happens when you sell? So depreciation is a deferral, and it's due one day, unless you follow the steps I'm going to lay out. There's a thing called depreciation recapture, which means that if you've taken X amount of depreciation, you get to recapture it and pay those taxes. So remember, this is essentially a deferral of taxes. You paid the same or although less if you essentially transformed it to long-term capital gains. Although passive income is treated very well as well. If you're essentially paying in the future around the same amount that you'd be paying now, so that net present value is just a great deal. You rather pay stuff in the future than now. You can invest more of that now. You can compound it now, and you can snowball it like I have. So when you sell, there's capital gains usually, hopefully, if the property is appreciated, this equity you built up. So there's two options to do that most real estate investors do when they sell the property. And this is why people sell the properties quite often, actually. They don't pay taxes. They don't pay taxes. you can do two things. One, you can do a tender exchange, which I'll go into, and that will defer your capital gains, including uh, your depreciation recapture. Or you can buy something larger, and essentially it's called investing into something larger and then taking that um, loss from the new investment and writing off on the current investment gains. This has to be done in the same calendar year. I've done this a few times. And I'll illustrate that now with bonus depreciation. So in 2017, a new law passed and a lot of goodies there. Cost segregation is essentially an engineering study of a property and essentially looks at, okay, there's a bunch of carpet here, there's HVAC systems, there's these things that are part of the incorporated part of the property that's going to be maybe a 15-year life cycle, 7-year life cycle, anything 15 to 5-year life cycle or 15 years and below life cycle of depreciation. And you can only do this with cost segregation study. You can now take in year one. You can depreciate in year one. And so that's accelerating your depreciation. The net of it is essentially you get a huge loss write-off in the first year that depletes your depreciation that you allow for the remainder of the year. So it's just going to be less. So let's revisit the same example that we just did on the same property. But in this case, we did a cost segregation study. And I'm estimating here, this is kind of generous, but I'm assuming that, but I've done this before where this is the same ratios. I get essentially 30% of my purchase price as a bonus depreciation, which is a really cool factor if you think about how much money you put into it. You put $250K in, you get $300K of losses. This is outsized, and I don't think this is something I would set as an expectation. Typically, maybe it's more like 50% or 70%. Although I just did one last year where it was roughly 120%. And so you use that depreciation to offset your passive income, because depreciation is classified as passive losses. And so it's just a net operating statement. It's a P&L, and there's three types of incomes: active and earned income, portfolio income, and passive income. And real estate classifies in passive income. Depreciation classifies in passive income. And so in this case, you're not really getting too much net value because you were paying zero taxes anyways on the previous example. But the power of this is you are able to use that 275K of additional losses and write off any other passive income that you might be earning. And it's really about accelerating those depreciation that you might have need to wait 27 and a half years on to now. And of course, it's a depreciation recapture on that. But if you do the next thing I ask you to do, or you should do, then you don't have to pay that. So then what happens? You sell, you pay it out, and you take you invest in a larger property. If you keep investing in larger properties and you never do tender exchange, you can do the cost segregation study and wipe out all the capital gains. Ideally, you do this 2-3 times, and then you do tender exchange to capture some of the excess gains. It's complicated math, but it definitely works. By the way, if you invest in a syndication or a joint venture or some kind of entity that you have a direct ownership on, like what I do, you get the same benefits. If you invest in a REIT, you don't, because the depreciation doesn't pass through as a direct owner. So differences between a REIT and a syndication or such what I do. So the other part of deferral, and more popular part, is a tender exchange. So some of you guys might know this very well and might know what it is, but let's revisit it. So when you sell a property, you have 45 days to then identify up to three properties within 45 days of escrow, and then you have 180 days to purchase that property. That's pretty much the timeline. It definitely can be stressful, but usually if you plan it right, it's a really great way to do tender exchange. Usually QIs, qualified intermediaries, which help you do that. At least the exchange portion of it. The money can't touch your account. You got to go to your QI. Maybe it costs around $3,000. So the really cool thing with depreciation and tender exchange, an amazing synergy, is when you invest in rented property, you cash flow, you pay no taxes on the cash flow because you got depreciation, or you pay very low taxes. You then you sell it, and you don't take the capital gains. You tender exchange it, and get more losses. By the way, you're just accumulating losses. You losses all day, and by the way, these losses are carried forward indefinitely. If you can't use all these losses, you can use it in the future. So hopefully you'll get more gains in the future, but these losses are usually upfront. So another concept I love talking about is this cycle, tender exchange cycle. You invest, cash flow, tax-free, tender exchange, invest, cash flow, tax-free, tender exchange, die rich, hopefully. So I mentioned die rich part because when you pass away, if you set up properly, your estates pass to your heirs tax-free, and the cost basis, which should be very low by now, steps to the fair market value. And your heirs aren't stuck paying a massive tax bill that you owe. So let's talk about an example here. You got $1 million property, like we started at. You've accumulated equity into it. You buy a $2 million property, next one. You get more depreciation. You have now a huge depreciation recapture bucket. Your cost basis is lower than because you essentially translated that. And by the third property, now you have 4 million. You double that again. Your cost basis maybe even lower. And maybe the fifth property or sixth property is like 10, 20 million, and it's all the way down to zero. And if you ever have to sell without doing tender exchange, you might owe tens of millions of taxes. But if you pass away, and your heirs inherit it, then it steps up to the fair market value, and the cost basis goes up to the fair market value. And so they can sell it day one and pay no taxes on it. Really cool way that a lot of people in real estate have been using. And of course, you're living off the cash flow, and the cash flow is increasing every time you buy a bigger property that has more income potential. So a lot of this came from the 2017 Trump tax cuts, and the bonus depreciation came from there. Who knew that a real estate investor would pass real estate investor friendly laws? Another thing that came through was pass-through tax deductions, which is another thing that I use sometimes, but not going to get into that. And then opportunity zones. So some people have probably heard of opportunity zones. It's a really cool new thing that is just starting to gain popularity. But I'll talk about that a little bit in its history. I have a friend who works in Apple and who works as a lobbyist, as I'm sure Amazon has many lobbyists as well. And so he told me a little bit the story of how this law got passed, and it was Sean Parker, ex-president of Facebook and founder of Napster, who was instrumental for this lobbying. You would imagine that people in Silicon Valley like us, and especially him, has a ton of stocks and they have a ton of capital gains, making a ton of money, they're paying a lot of taxes. There's no vehicle before this to offset those taxes. You can use DSTs, but they're tricky and high load costs. So he lobbied for that, and a couple $1 billion later, he looks like this. And now every 1% in Silicon Valley wants in on the tax code. I think they paid like $4 to $5 million for a lobby, and they got a ton of great returns on that, saving billions of dollars of taxes. That's amazing. That RI, I should hire a lobby firm for something. So the operating zone map, essentially it's state dictated. The local governments will dictate where these exist. The theory behind it is just like special incentive zones, or, if you're opening a new campus, you get a tax treatment, favorable treatment. It's basically, it's supposed to be about improving impoverished or areas that need to be improved. That's not always the case, though. there are parts of Seattle that's opportunity zone. There's parts of San Jose that's opportunity zones. Parts where there's very rich people. So it's not necessarily the case. It's mostly about politics. The benefits of an opportunity zone, there's 3 benefits. Tax deferral, which I think is probably the most important part for me. Essentially, so imagine you sold 200K of Amazon stock, and your cost basis is 100K. You owe taxes on the 100K of capital gains. Maybe it's 30%, whatever it is. Depends on what state you're Washington, probably less. That means that you only have 70K to invest in instead of 100K. In this case, you essentially can invest the full capital gains portion of it into an opportunity zone fund or opportunity zone crowdfunding opportunity zone business, and get and basically defer those taxes you owe, those 30K taxes. The second benefit is once you hold it for 5 years, and you have until essentially December 31st, 2026, so 5.5 years, is that right? 6.5, I don't know, to defer your taxes. And then when you owe those taxes, you owe 10% less on it. So not only do you owe this 10% less in the future, but you also owe in the future. So, I mean, time value of money, hopefully you're compounding your money every year by being a professional investor. The third benefit, and I think it's a really cool benefit because it goes hand in hand with all the stuff that I talked about, is a tax-free reinvestment. So if you hold it for 10 years, any future capital gains of the asset, not necessarily of the cost investment, of the capital invested, but if the property appreciates 2x, or even like 20%, and you leverage at 80%, you're actually 2xing your equity. And so you would owe a ton of taxes unless you do tender exchange or the other things they mentioned. But in this case, you don't have to do anything. You just get all those capital gains. You sell it, capital gains, after 10 years, you get tax-free. Amazing. So eligible gains, sell stocks, which is the big thing for most people. Sell a business, so you sell a business, you can use those gains in option zones. And sell real estate, although most people who have real estate don't necessarily use them, although there are ways to do it, because if you don't do a 10 exchange, for example, and your property is $1 million, and you have a $900,000 cost basis into it, and you're only making 100K profit, is it really worth it to do 10 exchange? Some would argue it's a bit restrictive. So what you could do instead is invest 100K of profits into an option zone, and then use the other 900K, and maybe your equity is only like 400K, invest in wherever you want. So you don't have to invest the full equity stack, the 500K, whatever equity stack you've put into it, or you've accumulated into it, into a tender exchange. So it gives you a little bit more flexibility, although most real estate investors don't necessarily use it for that. So a new notice happened a few months ago, given COVID, that essentially, I'm not going to read this, you have a lot longer window to invest. Usually it's 180 days to invest from your capital gains event. But in this case, for this year specifically, you have up until December 31st to invest things from as far back, and I did the math, as October 18th, 2019. So if you have capital gains from October 18, 2019, or in 2019, and you pay taxes on them, try to look for opportunity zone now and invest it within the end of the year, and then file an amendment, and then get those taxes back. I got a bunch of information here. I'm not going to talk about it because no time, but hopefully you guys get the deck and can read through some of that. So that's deferrals. Shifting is another way to rearrange facts. And the way that I think about shifting is there's a bunch of categories here. Active to passive. So that's similar to like long-term to short-term capital gains when you're day trading versus value investing for long-term. You have a different tax treatment. Airbnb income, short-term rental income, versus long-term rental income, which is 30 days or more. is taxed differently. They're taxed as active and passive. By the way, if you're doing Airbnb short-term rentals, another trick to this, not trick, another way to do this is essentially to have two entities, one that does the long-term rentals and rent it to the Airbnb entity that you also own. And the Airbnb entity essentially creates the short-term rental interest, but then pays the long-term rental rates, and you net it out so that the Airbnb doesn't make anything, and you convert all the income into long-term passive income. Another way to do this is, obviously shifting is about shifting from now to later. So deferrals, option zones, like I said, 401ks. High to low income shifting is another very important point here. And it's something everybody can do if you have kids. I'm not sure if you see my screen, myself, this guy, Aiden. He's 2 years old. It's a bit young to be a model, but he is a model, and I'm paying $12,000, and I get to reduce my top end tax by $12,000. If you have kids, I think CPAs usually advise maybe age 7 or 11. I don't know, something where it's like legitimate. But I do a marketing business, so that's my legitimacy. So you can pay $12,000, shift your income. $12,000 is the limit for where you don't have to file, taxes. I think, or you, at least you don't have to pay taxes on it. So income shifting, corporations do that a lot. Consumption to expenses, another way to basically shift and rearrange facts. So, for example, one thing that you could do if you had a business, and it makes it easier to have a business, is that you could rearrange the facts of your home gym expense, your home office expense. You could also just depreciate cars, vehicles over 6,000 pounds. It's a 6,000 pound rule. Tesla Model X qualifies, and maybe other cars and trucks. If it's 6,000 pounds, you can depreciate it, write it off completely. And it depends on how much you use it for business versus pleasure or personal. If you're a cool trick is to essentially buy it in December 30th and use the one day as business, and then write the whole thing off for that year, and then reduce your taxes by a lot. Since you have a much more affordable Tesla Model X. And of course, the other shifting is after tax to pre-tax. So it's a lot of information here from like other deep dives I could provide as well. I'm not going to go into the more complicated stuff like oil and gas, which can can reduce your active income a lot. Oil and gas is one of the most tax favorable investment strategies. Land conservation easements, which is actually a big purchase of a write-off. Donald Trump uses this a lot. It's kind of risky now because they have IRS task force, but a lot of rich people still use it. Essentially, it's a 4 to 5x return on your investment in terms of a loss write-off. And California participates in that as well, up to half your AGI. The net of it is like you can invest 50K, you get 250K of losses that you can now write off your active income. Another thing that you could do is essentially turning passive income to active income. And why would you want to do that? Because passive income is treated much more favorably. The reason why you want to do that is because you have a lot of passive losses because of depreciation. And you really don't want to do that, of course, when you have that. So how do you do that? You can become a real estate professional. And most of us can't, I would suspect. But this is a flow chart to see if you qualify. If you make less than 150K, 100K, then I think you can get some of those losses and use it against active income. Another trick to do this, I should stop saying trick. Another way to do this is essentially having your spouse, who are you filing married jointly, to be real estate professional, and then because you're filing the taxes married jointly, all that comes into one, and so all of your passive losses become active losses, and your active losses offset your active income. So another way, if you are a high-paying income earner and your spouse is less high-paying, or a stay-at-home person, then maybe have the conversation. We could save this much in taxes. You could work nothing, or maybe not work at all and become a real estate professional. So research it in terms of like there's a requirement, 750 hours, etc. So I think everyone should try to figure this app out if you can. There's tons of real estate people making money, and they need or at least tons of high income people who need to be matched with a real estate professional. It'd be really cool app idea. So 90% of all millionaires become so through owning. I think people have seen this through owning real estate, and it's true. And this is when millionaires were a big thing. Probably not now. Say tens of millions. It's more a big thing. More money has been made in real estate than all industrial investments combined, and that continues to be true. So you should definitely invest in real estate or learn to invest in real estate. And when I say invest in real estate, I mean investing, not buying real estate, not buying real estate and hoping that it appreciates. Buying in cash flowing real estate is one of the best ways to do this. And unfortunately, that's not likely in the areas we live in because those are expensive. The value proposition there, price rent ratios aren't great. I'll end with this. That makes it smart. Donald Trump, 2016, probably 2020 sometimes as well. And I'm getting a little personal here. This is something I just finished filing my taxes today. This is my 2019 taxes. This makes me smart. I think 500K, I made 500K. I pay zero in taxes. And for my real estate, I probably paid 4% taxes for the last 12 years. I have a huge write-off, by the way. That's from depreciation. All right. Well, that's the presentation. I went faster than I thought since there's no questions. But anyone have any questions? Open up to John in the forum.
Hey, so I'm just looking through the chat, and Terrence asked, when you were talking about cost segregations and 1031s, what circumstances would you, or why wouldn't you do both a cost segregation and a 1031? And what circumstances would make it better to skip the 1031?
You would probably almost always try to do the 1031 and the cost segregation at the same time. I don't think it's mutually exclusive at all. The cost segregation, let's talk about cost segregation first. You would probably only do cost segregation when it's a certain size. There's a cost to the cost segregation study. Usually it's around $3,000 to $5,000 to $6,000. If the tax write-off portion isn't that much, I wouldn't advise it. Some people say 500K. I say kind of like $1 million in purchase price, depending on the land value. So if it's like a 200K building, it doesn't make sense from a fixed cost perspective. It's not going to generate that much, bonus depreciation in the first place, which if it's not, then that $5,000 isn't worth it. I paid $5,000 for $7 million buildings, for $20 million buildings. Definitely worth it. I think around 1,600K maybe, depending on the land value, is sort of like a cutoff point where I think it's worth it. And by the way, you can do cost segregation study on previously purchased properties on the purchase price. So you can go back in time and do it. So even if you bought something 10 years ago, you can still do it. Of course, so the other question is, when would you do 1031 exchange? You probably wouldn't do 1031 exchange if you didn't make money. So there's no capital gains to exchange. If you lost money, no capital gains. You probably wouldn't do capital gains if the capital gains is a very small amount. You probably only do capital gains 1031 exchange when it's a significant amount that you want to offset and shelter.
Cool, thanks. So looking at two questions, I'm going to try to kind of convert into one. What got you started with out-of-state investing versus something that's close by? And then would you consider commercial to be more advantageous than residential?
I would definitely consider commercial to be more advantageous to residential. It scales better. But if you're doing this one-off, two-off, if you're thinking I'm just going to buy one or two properties and that's it, it really doesn't matter. I think if you're not thinking about scale at that point, you're not thinking about repeatable process, you're not thinking about variable costs. I think residential it's hard to scale because of loans, because of sales comparable costs. It is the most accessible. The reason why I started in out investing is because I grew up in LA, and it just by circumstance that I invested in 2009, where the market was very good to invest in. So obviously I got lucky, but I could do the math. I could see that it's cash flowing positive. By the way, I bought every one of my properties, and I bought almost 20 by myself, not using an agent, just direct negotiate. Just another trick, even for my personal property. This property I have here, this is bought a month ago. Out of state for me is I sometimes buy properties that are cross city, and especially when I was living in LA, and I don't try to manage it. I try to make this as automated a business as possible. Value your time, guys. Your time is worth a lot. You can pay somebody $10 an hour, which is what the property management costs, to do a lot of these things. So getting the exercise of investing out of state is a really good exercise of just investing remotely.
Great, thanks. Do you have any resources you can share about getting started, or like what's the easiest touch point for people to get started in commercial?
Yeah, commercial it can be as accessible, by the way, as investing. It's same price point as a residential. You can buy a single tenant, like Dollar General for $1 million or $800,000. That's triple net, and essentially triple net means that essentially the tenants take care of the taxes, insurance, management, common area maintenance. So essentially, it's just mailbox money, which is what a lot of people do with, and I have several of those. To get started, I think I have a whole other deck on how to get started, but feel free to reach out to me, by the way. I'm always open to conversations about taxes, real estate. Give me advice, why not?
Okay, thanks. And is there is there an income level that you would consider it worth it for someone to look into advanced tax strategies, whether it's like land easements or oil and gas?
Land conservation is around 300K. Oil and gas, 200K. I think you think about the top end marginal tax rates. If it's a progressive tax system you have, and so I think around 150, you're still in the borderline. It's just too complicated. There's a lot of expenditures. I think around 200 plus is probably where you want to start. I think it gets really optimal close to 300 to 400K. So that's where I would probably look at.
Okay. And another question is, can you take depreciation on raw land with no construction on it, or does it have to have a building?
So it has to have a building. You can't depreciate land. Depreciation is also really interesting. This is if you explain to somebody for the first time, it's like really crazy. Essentially, you can depreciate a carpet 1 million times every time you exchange hands, and the carpet would increase in value and then depreciate again. It's insane. So it has to be material good that has a shelf life. Land does not classify as that. Improvements on land does. I don't know the classical definition of that though.
Okay. And then are there commercial categories that you like better than others, whether it's like multifamily or office space, retail, like those things?
I own almost all commercial categories, self-storage, something I really like, multifamily, senior living, it's another thing I'm about to buy, office, retail as well. And I had some bumpy roads on that, but I also made a ton more money. It's all about your risk tolerance with certain assets that have perceived higher risk, like hotels right now or retail right now. Obviously, I wouldn't probably buy a big box retail. I probably wouldn't buy a Best Buy or a mall. But neighborhood shopping center, they offer higher cap rates, higher yields, obviously for the perceived risk factor. Multifamily offers lower rates, lower yields because it's perceived as a safe asset, which means the financing is cheaper too. I would say multifamily is probably the easiest to get in. It's the most available. It's also most competitive. I like it a lot. I buy most multifamily, but there's lots of different assets. And if somebody's giving me 30% yield, I might look into that.
Okay. Can you elaborate a little bit more on how you got your AGI to be negative? Did you have to cross some of your passive income to active or some of your
Yeah.
losses?
So in 2019, I had my wife become a real estate professional by working on managing my properties. And she also worked part-time at school as she's an educator. So she qualified for the hours count, 750 hours, and majority of hours spent on real estate. This year, I will be qualifying myself as a real estate professional because I'm not working full-time in Apple. Um, but essentially, that $1.8 million losses that you see there is from the purchase of large commercial buildings. For example, I bought a $7.2 million building or portfolio of buildings in November 2019, so recently. I put $1.5 million in. I got $1.8 million of cost segregation, bonus depreciation losses. I'm making 200K from that, by the way. 200K is great a year. Um, and I'm using that 1.8 million to write off this year's income. And because of the CARES Act, thank you, I'm going to carry back and take it against 2014, 2015, 2016, 2017, 2018, and claw back all those taxes I paid and essentially get around 400K tax refund. You have until 2020 to do this, so you can do this for 2020 as well. So when you do 2021 taxes, you can do that carry back, essentially taking all your net operating losses and using it for the past 5 years in that sequential order.
Great. And how did you go about purchasing without an agent? Is there like automation tricks or anything else that you use?
An agent is really there to handhold you and help you identify the right properties to buy and give you access to properties that you might not have access to. When you're buying personal property, residence, you know, so many internet platforms now, Redfin, Zillow, that allows you to find these properties easily. You have as much access as someone who has an MLS account. So there's really very little value unless you really want that concierge service, which yeah, I totally get why people would want that to understand what neighborhoods you should live in. That's the advice that I usually would find very valuable. But negotiating with a selling agent, saying, "Hey, I'm a buyer. I don't have an agent." They would pick up the phone very quickly. They would put your offer top of the stack. You could get a lower offer accepted, which I have done, because they get double commissions. Would you want double commissions on a smaller value versus less half commissions on a slightly bigger value? For example, I bought one of my properties, my first residential property to live in after buying three income producing properties. It was a short sale for 450, and I knew that there was another offer for 530, and mine got accepted because of that. This short sale is just a little bit complicated, and that was probably the only reason why it could happen because the bank is a seller.
Cool. What are your thoughts on residential investments in high cost of living regions? Do you have a cap rate that you target?
Yeah, don't do it. High cost of living areas generally means that people can afford more. Affordability drives residential pricing. Affordability drives, I'm in the Bay Area, and I'm not sure if you guys in Seattle, Bay Area, or wherever you guys are. Uh, it's a crazy thing in the Bay Area. Real estate prices are going up. Rent's going down. It doesn't make sense. Cap rates are around 2, 1, 3%. I think to start making money, your cap rate needs to be above the loan price, right? And that's being generous. I think if your loan is 3.5%, you should probably buy 4% to make any net cash flow. It makes
Okay.
sense potentially if you're trying to buy for appreciation, but I'd rather just buy company stock of Tesla and Apple in the Bay Area stocks because that has a better correlation to appreciation.
Thanks. And where do you find leads for commercial investment properties, or where should somebody after this talk try to go find leads?
So this is where probably a agent is helpful, but there's also sites and broker sites, And it depends on where you're looking for. You can look on loopnet.net, or is it .com? One of those two, LoopNet. It's not a great place to find good deals. It's actually what we in the industry call the graveyard of deals, but it has a lot of category. It has a big catalog. Crexi is another one. CREXI.com, another place where not great place to find deals, but great catalog. You can look up all these properties, and when you look at commercial properties and how they pitch it versus residential properties, they talk about the numbers. They talk about the yield. They talk about the cap rate. They talk about the financials, and they have all that information. And so you could even see a commercial property that's like a four unit, and they classify it commercial, but they have it all set up for you. Versus like buying a Redfin, you gotta do the own calculations and whatnot.
Sure. And if two friends own one investment property each, can they keep 1031 exchanging to each other to never pay depreciation?
Yes. If it's arm's length and it's not related to each other, yes, you can do that. And you can do that every year and keep getting depreciation, bonus depreciation. Remember, the depreciation follows you as a tax holder. It doesn't follow the property. So a property could offset $1 million property offset and create millions of dollars of depreciation over its lifetime. And if you buy sell every month, then yeah, creative idea, guys.
What's your advice on investing through platforms like Fundrise and CrowdStreet? And are those as tax efficient as investing in a syndication?
So CrowdStreet is essentially a syndication platform. It's a marketplace platform, and they've approached me, for example, and usually it's the funding platform. They get cut. And so it's treated like a syndication once you're in it, though. So for you as an investor, it shouldn't really matter who gets a cut, who makes money. It should just matter how much money you make. Are you comfortable with this asset to invest in? Fundrise is slightly different. There's a lot of different types of crowdfunding sites like this. New regulations has made it much easier. I'm sort of like this, it's a much smaller scale. I don't go on these other crowdfunding sites because I don't have to pay commission. Most of my deals are funded very quickly, so it's not that I need capital access. It's usually the lower deals. Fundrise has a 1% management fee, and then in some cases they don't even pass through depreciation. So make sure wherever you invest in as a direct owner, even though it should probably still be a limited partner or a passive investor.
Thanks. And then if you're doing a cost segregation, you're front loading the depreciation, and then you do a 1031, so you don't have to pay it back. Is that the right way to think about it?
Yep. Yeah. Your cost segregation, your bonus depreciation essentially is a deferral, and you essentially build a big. Essentially, you take your cost basis. So if you bought something for $1 million, you take a bonus depreciation at $300K. Now your cost basis is $700K. And so when you sell it, even you sell it for $1 million, you have to pay $300K of net taxable income, right? Of capital gains and depreciation recapture. But if you tender on exchange that, you take the $700K cost basis into the next property, which might be 1.3 million, and now but your cost basis is 1.3 million, is the 700K. And you carry that depreciation recapture as a owed account, a debit, I think that's right, into the future. And then you keep doing that until no one's holding the bag.
Okay. And then what type of person should be looking into the CARES Act tax changes?
Somebody who has a lot of losses and can take advantage of it, and also is maybe a real estate professional, wife, spouse, husband.
Cool.
Something like that.
All right. I think that's it for questions. Do you want to put up your slide again for people to get in touch with you?
Yeah. Feel free to reach out to me. At Jose Capital, my website, wherever you want. Happy to just talk about taxes and real estate. I love the topic. Try not to pay taxes, guys. It's one of the easier things to do if you know the avenues to do it.
Okay. Thanks so much for your time and giving us this education. For Amazon folks, I'll post the recording. I'll find a place for it, but I'll also put it in the Slack channel as soon as we're done here. So thanks a bunch.
Thanks, guys.